You can invest in gold, whatever your age, and hold it for the long term and get not only the preservation benefit of protecting you from fiat money that's burning. It's literally like, buying CDOs during the real estate crisis when mortgage-backed securities were dying. They were handing out insurance on that for free. You can still protect your paper wealth by buying physical gold, insure against its debasement, but you'll probably also see massive appreciation in the price of that, spot price of that metal. And this is what Jeremy Grantham's third investment advice was: buy when you're terrified, not when you're cocky. It's sad that we're worried about the Epstein files or Brigitte Macron when the real problem is math. It's our debt. and it's sad that we're not able to see this because it's boring. It's not sexy.
All right, today we're having a chat with Matthew Piepenburg, of course, author, financial and precious metal analyst, as well as partner over at Von Greyerz. Matthew, thank you so much for swinging by.
Well, it's a pleasure to be here. Thanks for having me. I'm always looking forward to the conversations.
Excellent. First question I have is, and there might be a bit of young naivety behind this, but it feels like with conflict brewing all around the world, with government debt skyrocketing to unprecedented levels, as well as 3 Sigma events happening almost daily, it feels like. Are we in a time of great change?
It's absolutely unprecedented in a lot of ways. I was thinking the other day, I have a lot of mentors who came out of college in the late 60s. A couple guys who came out of Yale, went straight from Yale to Vietnam. Literally, they graduated, they were on a plane, and they were in Khe Sanh, a week or two later. It's unimaginable. But they had just come through an incredible period in the U.S. I mean, we just had what I consider almost a coup d'etat for JFK, killed in '63. We had Martin Luther King and Robert Kennedy assassinations. We had racial unrest. We had the Vietnam War debate. That was a crazy time. And when I talk to these mentors today, they're much older, obviously. They describe the current period politically, financially. A lot of these guys are market guys. Socially as far more disruptive, volatile, and unpredictable than the late 60s and early 70s when we were having so much political and social and financial crises kind of coinciding. Today, we've got over 1.5 million dead Ukrainians in what I consider a proxy war to weaken Russia on the backs of Ukrainian civilians and soldiers. We've got 50,000 dead in Gaza and counting, out of a population of 2 million. International relations have never been worse. Global trade is the worst since 1949. The U.S. has a serious rare earths problem for a lot of its chips. It doesn't have the raw material for, in a world going very technical. Interest expense on U.S. debt is greater than defense spending. That's something Neil Ferguson warned is a leading indicator of the failing of an empire, like the Dutch, Habsburgs, British, the Ottomans. You've got academics like John Mearsheimer kind of bringing out that U.S. policy since 9/11 is probably a disaster. Iraq, Afghanistan, Libya, Syria, etc. And now we have wars in the Near East, the Far East, Pakistan, India, Cambodia, Thailand. It brings to mind Hemingway's quote that as nations become more debt desperate, after the temporary prosperity of living on a credit card, what always follows is the permanent ruin, I've said many times, of debasement of the currency and war. And now look at what we're seeing. The main interest for family offices and high net worth investors is inflation and war. And it is an incredibly tumultuous time in the markets, in politics, left or right, center, Europe, the U.S., South America, and military conflicts, and of course energy and war. I talked to the anonymous chicken Doomberg more than once, and he's a brilliant thinker. His team is really brilliant on energy. And as he says many times, energy is life. It's the base layer of money. We burn energy to produce and pay for things, and power is really not from the U.S. dollar or a fiat currency, but from energy. And if the cost of burning energy gets too high, you bust. And why are we at wars in places like Iraq and Syria? Why are we bombing Iran? There's lots of different reasons. Why do we have an 80-year relationship with Saudi Arabia if we're so pro-democracy? And we have to be realistic. It's about energy. Iran is 30% of the oil, and even higher natural gas. The Strait of Hormuz is very important. These teapot refineries, etc. So all these things, they make look moral issues or geopolitical issues come down to very boring things like power and energy and money and currency and the debt used to sustain that whole facade. And so in each of those silos, whether it's markets, whether it's social justice, whether it's politics or geopolitics, whether it's military issues, whether it's currencies, whether it's precious metals, everything kind of cycles around power and money, and money really is about debt and credit. And as we have a debt crisis and the end of a credit cycle, we have the end of a currency cycle. And so all of these things are interconnected. And it's not academic. It's there. If you look at it, the facts are there. Your opinions can be whatever you want to make of it. But I always go back to starting these conversations about the turmoil in the world is really it's a debt crisis, and a debt crisis is a credit crisis. And those debt crises always ripple into everything else, including centralization, loss of civil liberties, loss of inherent purchasing power of fiat money, the rise of more control, the rise in the precious metals prices, and a rise in just uncertainty. And far more importantly, perhaps, is a rise of desperation, because great nations like the U.S., I'm an American living overseas, I've spent half my life in both areas, but throughout history, countries don't give up easily their hegemony and their currency's hegemony and their political powers. And what we're seeing right now, whether you're left, right, or center, is a very desperate attempt to stave off the inevitable. It doesn't mean the end of the U.S., but the world is changing, and it's changing without a lot of, I would say, elasticity or smoothness. It's changing very violently and very tragically in a lot of ways. And again, getting past partisan politics, which no one's an expert on, everyone just has an opinion, I think we can all agree that our sacred cows and our sacred values and our sacred beliefs about a smooth American-led, dollar-led world or a U.S. moral guidance is not the same today as it was 10 years ago. And the world is reacting to that in sadly, mostly negative and violent and militant ways. And that's just my take on this crazy time.
Yeah, it definitely feels like a crazy time. And I know you like to focus on the long-term debt cycle. I believe that's quite important as well. Do you think that really has a causation towards all these other factors as well? Or is that more of a leading indicator to predict these long-term cycles?
I think it's a good question. I think it's both. That's the Piepenburg broken record. I bring up every conversation with debt because I think you can't overstate it enough. And I will repeat it until it's understood, or at least examined by every investor or everyone curious about the world. I'm not saying I'm right, but I think I have strong conviction. I think debt is a causation and an indicator of things breaking down. And again, global debt has gone from 30 trillion to 300 trillion in a matter of decades. It's appalling. When I was born, U.S. debt was roughly 240 billion. It's now 37 trillion and counting. And again, it's worth pausing. I was talking to John Rubino. A billion seconds ago places us somewhere in the mid-90s, 97. But a trillion seconds ago places us at 30,000 BC. So the difference between a billion and a trillion is massive. And going from 246 billion in debt in my lifetime to 37 trillion is just unsustainable. My colleague Egon von Greyerz in 2016 was saying we're going to see the U.S. at 40 trillion in debt by 2025, 2026. Everyone thought that was crazy. But U.S. debt doubles every 8 years since 1981. So he was right. And that just seemed insane in 2016. You fast forward a decade later and we're there. Household debt in the U.S. is 97% debt to income. It is impossible not to talk about debt. It is impossible not to overstate or understate or discuss it enough. And I always say the bond market is a thing, but it really is the credit market, it's debt. They're all tied together. It impacts everything. I can look at the future of geopolitics, not with precision, no one can. I can look at the future of stock and bond markets, not with precision, but no one can. But I can do it with pretty strong accuracy or conviction. When I look at the markets, I look at the bond markets. I was a bond guy before I was a stock guy, and I was a stock guy before I was a precious metal guy, and they all are connected. But in 2019, we had a repo market crisis. That was a credit crisis, 10% interbank lending overnight. That was nuts. In March, we had a great sell-off during COVID. That was really a crisis in credit and bonds. U.S. Treasuries and stocks tanked, and it wasn't saved by anything other than unlimited QE. In 2022, we saw a gilt crisis. Again, there was a problem in the bond market. The great banking crisis of 2023, which no one talks about anymore because apparently it's been solved. But that was for the 5 largest bank failures in our history. And that was considered a bank failure, but it was really a credit failure because the underlying bonds, the treasuries held on those banks as safety assets, were losing value under Powell's higher for longer policy. So that was a credit crisis. The 2025 crisis in April, which was cured immediately by the Trump two-step, was not a tariff crisis, it was a bond crisis, because when he announced Liberation Day, there was nobody at the Treasury auctions the next day. I don't know what happened in D.C., but I'm fairly certain that Bessent walked into his office and said, Liberation Day and these tariffs on China, etc. no one's buying our U.S. debt, no one's buying our IOUs, and yields spiked. And within minutes, Trump had to do a two-step and recant on his liberation policy. So again, all these things are led by debt, by credit markets, by U.S. treasuries, which are just a form of credit or debt. So, you can't look at the stock market without looking at the bond market. You can't look at U.S. foreign policy without looking at our debt levels. It ties the hands of our policymakers. And, when you have a debt to GDP of over 120%, what can you do? Trump in the U.S., for your foreign audience, or maybe not as familiar, was trying to cut spending at the government level under this Doge program and have 75% pink slips in Washington and just cut out the bureaucracy. But he could get just as much money by cutting rates by 25 basis points, because that's 25 billion less in interest expenses. And so was Doge really as important as cutting rates? And now Trump is obsessed with a rate cut with Powell at the Fed, and we'll see what happens this week on that. But debt to GDP at 120%, we were learning of this in the 1700s. David Hume said when you cross Rubicon of 100% debt to GDP, growth is cut by a third. So you can't grow your way out of a debt to GDP problem this high. So you have to bring down your debt to GDP. The problem is our entitlements, our defense spending, and our interest expense alone on our U.S. debt is 75% of our budget. So there's not a lot to cut. And that same entitlement, interest expense, and in defense spending used to be 65% of our tax receipts in 2016, and now it's double that. So there's not a lot of wiggle room to cut the debt. How do you cut the debt? How do you cut the spending? How do you get the growth? And again, you've got to raise GDP by improving manufacturing and bringing the P back in the GDP. You've got to reshore jobs and make America what it was pre-2001 when we offshored the American dream to China. You've got to bring that productivity back, but that too is expensive, so that raises the debt to get to growth. So we're in this vicious cycle, this debt trap, where there's really no way out without some serious austerity, which politicians really don't want to talk about because that's not easy for re-election, and politicians think in election cycles, not long term. Our only options really are to default on the debt, which wouldn't happen, some type of productivity miracle, which I don't think is going to happen. We can inflate away the debt by just debasing the currency, have an inflation rate higher than the yield in the 10-year, and run negative real rates, and we'll lie about the inflation rate and do it anyway. We could have a big reset after the 5 stages of grief. But there's really no easy way out. I've always said cryptically that, Papa Smurf, Santa Claus, a Nobel Prize winner, no one's going to save this debt crisis without massive austerity and a recession. And this is the problem today, I think, with a lot of economists and sort of a lot of politicians. Most politicians understand nothing about basic math and economics. They don't. They understand ego, power, and resume, curriculum vitae enhancing. They have an embarrassing lack of understanding of economics and in history too. And there's the academics that work at the FOMC or give advice. Most of them don't know really how to give advice, but they're really based on model thinking. The Fed is based on model thinking, and there are great Fed alumni like Thomas Hernig. There's a British Lord Mervyn King. He says the model thinking, this optimizing thinking, is really kind of naive. They always try to optimize, even in a worst case scenario, and I always compare that to the military academy at West Point in the United States. They don't look at optimizing. One of the first courses you take there is how do you prepare for things when things go really wrong? How do you pull off a good retreat? How do you admit or know when you're losing? How do you do the logistics to get your men out of prisoner of war camps, etc.? How do you avoid a major catastrophe? Economists and politicians only want to optimize. They only want to see the best. And the world is far too complex for an optimization model now with these debt levels. And Hayek understood the limits of knowledge and the limits of math. And I guess that's a long way of saying the debt crisis we're in, the highest in the history of humankind, the highest in the history of capital markets, is completely unsustainable. That is not meant to be bearish. That debt can be monetized and paid for with mouse click money or money literally created out of thin air to monetize that debt, but you could only quote unquote solve the debt crisis without austerity by debasing the currency. So that's how it's tied to why precious metals and gold in particular are rising, because fiat money is dying. And the other way, of course, is the war dividend, which is what Hemingway warned about. And I'll end there, but the idea of debasing the currency and distracting the world in war, while you're failing with your debt policies is nothing new to history. It's been seen over and over. The other thing that's nothing new to history is centralization, the decline of civil liberties. That ties into stablecoin and AI and et cetera, and we can get into those conversations, but they're all kind of connected. This theme of debt, desperation, war, currency debasement, geopolitics, inflation, and markets that are sustained by monetizing that debt with debased money. That is the world we live in, and it is tied to debt. I can't say it enough. If you understand the bond market and the debt markets and bond yields, you'll see, not with perfect clarity, but you'll see very, very clearly the direction and the lack of options available to, politicians and policymakers who can pontificate with wonderful words, but those words always hide bad math and transparency and clarity. It's just the more things change, the more they stay the same.
Perfect. Thank you for that overview, Matthew. And two follow-up questions on that, really. First one is, I understand you're really describing a realistic view of the politicians that we have in the Western world. But in an idealistic world, can anything be done, or is this type of a Lynn Alden scenario of nothing stop this train? And two, perhaps we can talk about some historical parallels to really look at what will follow from this credit cycle.
Yeah, I mean, it's a philosophical question about what is man, human nature, what is a politician, what is a human being. Can we be transparent? Does the truth set us free? Can a politician sit down in a fireside chat and say the quiet part out loud? We have spent more than we can produce. We have spent and gone into debt far more than tax receipts or GDP can pay for. A lot of it is our fault because we were living on the addictive high of modern monetary theory and this fantasy that you could solve debt crisis with more debt and then pay for that debt with mouse click money. If politicians came out and said the truth, that would be fascinating. I think an example of someone who said that is Javier Milei in Argentina, and that came after a series of just failed regimes, left, right, and center, military to communist to extreme conservative. The inflation, the Peronist state, the absolute failure of the peso, the population was on its knees in the sense of this nothing is working. So Milei could come in with a chainsaw and four-letter words and just this refreshingly blunt way of mocking the financial system in Argentina and the world and making radical changes, facing radical austerity, making radical layoffs. That's Doge times 10 in Argentina. That's an example of someone who had the mandate because the people were that, as I read somewhere, when you're standing in the rain long enough, you're willing to get into anybody's car, and eventually you'll look for the best car. By that point in Argentina, Milei could say and do anything and make radical changes and be honest and blunt about the failure of the system. I don't think anyone in the G7 countries or anyone in the U.S. will say that as obviously as Milei. Trump and Bessent will talk about debt more than Biden and Harris did in the last administration and try to come up with executive measures one after the next. But legislation through Truth Social or Twitter or just executive act after executive act, where we could talk about the Genius Act and the Loomis Bill, etc. There's definitely effort, but as I go back to my original point, when you get to this level of debt, 37 trillion in public debt and over 100 trillion in household debt, corporate debt, and government debt, there is no easy solution. You can't create an external revenue service and tariff your way back to success. You can't militarily expand your way to distraction. You can't grow your way out of this. There has to be what the von Mises school, the Austrian school, understood decades ago. There has to be necessary constructive destruction in the market cycle, in the sovereign debt cycle, in the business cycle. We used to have recessions every 48 years ago. Now we've tried to outlaw them through this addiction to easy money and easy credit, low rates and big balance sheets at the Fed or the central banks to just postpone. By doing that, we've only made things worse and we've made our options more desperate. So what can be done? We would need a politician of extraordinary courage. We need a population that's willing to hear bad news, because the population, like the government, doesn't like to think about bad news. Jeremy Grantham said these are the two lessons he's learned. Investors don't want to hear bad news, and they don't want to think too far into the future more than the next 10 years will be the same the last 10 years. That's just naive. It's not meant to be doom and gloom. It's not meant to be bearish. I've been bullish in 2020. I was bullish in 2024. I'm not a perma-bear in terms of trading, but in terms of the grand picture of the world I see, I'm extremely bearish. It's unsustainable. You can't have, as I've said many times, a Ferrari appetite on a busboy salary. And that's what the G7 and the West and the US in particular have done. And they fed the world and themselves a fantasy that there are solutions. There are when debt to GDP is at 80% or 85% even, but not when it's at 120 and climbing. You've hit the wall. You've hit what I call the Stalingrad moment or the Waterloo moment or the Gettysburg moment, where like a West Point officer, you have to realize this war is over. Unfortunately, most countries and most economic powers don't want to accept a defeat, and like the Wehrmacht or like Robert E. Lee's Army of Northern Virginia, they kept fighting for 2 more years, and tens of thousands had to die because they just didn't want to accept defeat. We have to accept defeat that our debt policies, that our monetary policies have failed, that we're in a recession and we're in a monetary policy crisis at the same time. We have to admit it and say it out loud. And the population has to be willing to go through that austerity. The problem is the population feels like they've been hoodwinked, one, by their government and their policymakers, and another half of that population doesn't want to believe it, because certainly in America, the divide, the wealth gap between the rich and the poor is at historical highs. 90% of stock market wealth is held by the top 10%. So there is a powerful minority that wants things to stay the same and wants to run this fantasy and this debt addiction longer and believe that they're in control. And there's a forgotten middle class that has no economic power, but they're definitely getting frustrated. So I don't know if I'm really answering your question, but we need honest brokers at the highest levels of power. That seems absolutely Pollyannish and fantasy. And we need a population that's willing to hear that bad news and suffer the austerity for the benefit of the nation. But when that population is splintered and divided in everything from transgender bathrooms to BLM to race to minority policies to, I mean, understandably frustrated fragmentation, tribalism in Europe and in the US, it's hard to get that population to trust a government and to go in it together as Italians, as Americans, as Europeans. When trusting government from from the Epstein files to, Macron's wife, these headlines, is she a man or a woman? These are distractions, but trust is fading. It's sad that we're worried about the Epstein files or Brigitte Macron when the real problem is math. It's our debt. and it's sad that we're not able to see this because it's boring. It's not sexy. It's debt. It's yields. It's treasuries. It's boons. It's gilts. And of course, I look at the world through an economic lens, but I'm still a citizen of this world. I still understand history. I still look at the social unrest. I still look at wealth inequality. There is going to be no easy solution, and I go back to that Hemingway quote: if the only solution to this debt is more currency debasement and war, that's actually very tragic. I hope he's wrong. I hope I'm wrong. But the evidence all around us is just the same: more currency debasement and war. And it doesn't mean the end of society or civilization. It doesn't mean the end of the world. It doesn't even mean the end of major powers. But the things are changing so radically fast. The de-dollarization, the movement away from U.S. Influence, the movement away from U.S. power. Its failures in Afghanistan, its failures in Iraq, these are becoming more and more known. You can have whatever view you want on Israel. That power is losing credibility. Again, will they go down easily? Will they change easily? That's not for me to determine or me to judge. We can all agree, though, that the sacred cows of foreign policy by the U.S. or Israel or the petrodollar, the U.S. dollar, is fading, not overnight, but slowly but surely. And we're seeing that in the de-dollarization. We're seeing that in the rise of the BRICS. We're seeing that in gold as a tier 1 asset. We're seeing that movement not to end the dollar, but to reprice the dollar, and not to make gold just another asset class, but a core component of the next currency system, whatever that is, and the next reset to come, whenever that comes. They're already loading, and to use that military analogy again, you don't have to be a military genius when you see, as I've said many times, horses and cavalry and soldiers and infantry marching towards a border that the other side of that border has to prepare. They have to think, okay, something's coming. What we've seen monetarily and financially in the last 10 years, and certainly in terms of U.S. treasuries being dumped and gold being purchased by central banks, the slow de-dollarization, not the end of the dollar, the rise of gold as a tier 1 status, all of these things are a way of looking at how central banks around the world are loading up on gold, dumping U.S. debt, finding new trade arrangements outside of the U.S. dollar. Again, not replacing the dollar, not ending the FX power of the dollar, but we're seeing in slow motion, a frog boil of the world on the other side of that border preparing for what's coming. And they're preparing for a major currency and a major financial and a major market dislocation. And they're loading up on gold. They're dumping U.S. treasuries. They're dumping sovereign bonds in general because they see that credit risk. And they're even loading their guns, again, literally. But change is happening. Change usually doesn't come in a kumbaya, warm and fuzzy, let's all cooperate, John Nash kind of way. It usually comes with a lot of resistance, a lot of personal power held by a very small minority, whether it's Davos or DC, whether it's the top 10% of the U.S., whether it's the RNC or the DNC in our politics. It's further and further far from the plow of our democratic ideals. We've lost pretty much all 10 of our Bill of Rights, except for the Second Amendment, through the slow drip of things like the Patriot Act or the constitutional death of sound money. These are just facts. You can look at them however you want, but we're less and less of what we are in the name of keeping power. And I think that's very apparent to those inside or outside of the markets. But in the financial world that I look at, it still leads to uh-oh ahead. And not just in some predictive way. We're already seeing the uh-oh right now. It's all around us. And you don't have to wait for a market crash, and we can definitely talk about markets. They will crash. No one knows when, and no one. I can tell you the things I'm tracking and the things I'm measuring, but it will happen. And the only way it doesn't is we literally nationalize the markets and monetize the markets at the expense of the currency. So there is no easy way out. There is no good scenario. Again, very bearish. It doesn't mean the end of the world or the end of your ability to invest. You just have to invest differently, more carefully, more realistically. And that doesn't just mean precious metals, by the way. But you've got to be informed. You don't have to think the way I think or many others like me think, but you have to think. If you're going to your registered investment advisor or your consensus think banker, you're not going to get these other viewpoints. You're not going to get the risk management. Risk managers in Wall Street are just long-only directional traders. And whenever there's a crisis, they blame it on an extraneous event or a black swan, when in fact these black swans the gray swans are very visible. And I'd rather be years ahead than even seconds too late in preparing for these market dislocations, these currency dislocations that are literally already happening around us. So it's not even trying to predict or foresee, it's happening in real time, from recession indicators to currency indicators to market bubble indicators. And there's clearly a market bubble right now, and there's clearly market risk. And this is not just from a gold bug being perma-bearish. I've said many times I've been bullish on the short term, but the directional trend in these markets is historical. And I think they're worth talking about because they do affect us all. Even if you're not in the markets, that will affect the recession, it will affect the economy. Therefore, it affects your career, it affects your job, it affects your security. So you have to look at the dark side of the force without being permanently cynical. But the evidence is fairly overwhelming that we're in a major market dislocation period, and I think it's worth discussing even if we talk about gold and silver.
No, 100%. I would love to touch base on markets, and of course, history doesn't repeat itself, but it often rhymes.
Right.
Really, how should we look forward and try to sketch this scenario out? Should we expect a crack, a boom, like some people are predicting, maybe how the Weimar Republic did that right before the Second World War? Or should we expect a 1929 style Great Depression? What should we expect at the end of this credit cycle?
I was talking to Heinrich Sieberg in South Africa earlier in this year. He was right. He's just as bearish as I am. He's just as pro-gold as I am. But he saw a crack-up boom or a rising market into this. This is nothing new. We saw this in 1929 in the U.S. Great Depression and the market peaking there. We certainly saw in the Nikkei in '89. You can still be chasing these tops optimistically. There is an argument to be made for that. I think it is the most optimistic market in history. I go back to some of the legends who look at U.S. markets like Charlie McKay, who talked about the madness of crowds, this consensus think, this how can we get hurt if we're all in this together. Bob Farrell, who's almost forgotten, who says the most important force in the markets is mean reversion. Markets that are overbought always come down. Markets that are underbought always rise up. That's 75% from these highs would be a mean reversion right now. And of course, Benjamin Graham, who talked about value investing. I see markets today as being completely distorted and destroyed. Free market price discovery, capitalism destroyed by central bank intervention. They're very Pavlovian, I've said many times. And again, Druckenmuller, Ray Dalio, Paul Tudor Jones, Jeremy Grantham, Jeff Gundlach, Bill Gross, they would say the same thing from the bond and equity markets. It's not just me as a negative bear thinking precious metals guy. The markets move with the Fed or the central banks. When the Fed is supportive or dovish, markets rise. When the Fed is hawkish or unsupportive, markets fall. We saw that in 2022. Higher for longer was from March of 2022 to June of 23. Markets had the worst nominal returns in stocks and bonds since 1871 in the U.S. There was a pause in July. November there was talk of cuts, and then by 2024, when there was talk of cuts, the markets went up just on the talk of cuts. We didn't actually start cutting until September of 2024. But I was very bullish because the Fed was giving you a dovish signal. But these markets, the U.S. markets are 7x the global equity index. California, a state in my country, and 4 tech companies account for greater than 10% of its tax revenues. You've got the Buffett indicator of, market cap to GDP. That's an important indicator. It's as high as it was, higher than 1929. But more importantly, Buffett himself has hundreds of billions in cash. And the PE ratios we're seeing in the NASDAQ are at 49. And the S&P is only up 7% this year, and they're calling that a good year. Now, NVIDIA has a $4 trillion market cap. I think once yields on the bond market hit above 5%, that market tanks. But yields matter, and when like I said, in Liberation Day, the tariff was the blame for that market crash in April. But it was because yields got too high. As soon as Trump pivoted and cut back on the tariffs, the markets recovered. But we are in a bubble. When the S&P 500 is the main equity index for the world, the S&P 500 is really the S&P 7, because 7 companies, the Magnificent 7, have 40% of the market cap. It's even worse for the NASDAQ, again at 49 PEs. And I was an investor in GMO, which was run by a brilliant portfolio manager named Jeremy Grantham. And he hasn't traded in 15 years now. He's based out of Boston. And he did a study on bubbles. He looked at the Nifty 50 in 72, the Nikkei in 89, the dot-com bubble, of course, the great financial crisis in 2000. He looked at all of these. And what he reminds us is that high multiples always precede bad times. And this is the highest market valuation in U.S. history. I don't think that's a good sign. We saw that in 1929, as he reminds us, in 1972 and 2000, the dot-com, of course, 2007, and just before the great financial crisis. You always saw these last big peaks of overpriced markets. And even those don't compare to the Nikkei in 89, which was trading at 65 earnings. And so, it's important as we're looking at this not to try to time. That's impossible, but we can measure these markets. And, I was a hedge fund manager during the dot-com bubble. I was an idiot. I got lucky on some pre-IPOs. I was not Jeremy Grantham. I was riding a trend. I didn't know a stock from a bond, you could argue. That was just a buyer's market in the dot-com bubble. But up until, the dot-com bubble, equities never sold more than 21 times earnings since 1929. Then in December of 97, it hit 21, and 2 years later it was at 35. And it lasted for 2 years while I was making a huge 200, 300, 400% returns on an IPO. Gundlach was bearish. He was making 6%, but he was protecting himself. He was thinking further ahead. He wasn't trying to time it, but he saw that he was in a bubble. And I think, portfolio managers can never call the end of a bubble. And most portfolio managers, most pundits, most bullish stock sellers are going to always be bullish, and Wall Street will always be bullish. They're dreadfully, even though this is a dreadfully, objectively, quantifiably overpriced market by every metric. And Grantham, at GMO, never really publishes much except for his newsletters if you're a member of his fund. He rarely comes out with anything on his own. But he did say there are 3 things that he's learned: that man is tilted toward preferring good news, and that there's no interest in long-term thinking. In my mind, as the markets are ripping irrationally to all-time valuations, unprecedented, consciously man just wants to believe this is too good, this is going to last, it's going to be great, this is a new technology, this is AI, this is tech, this is a new world. But I think gold is our subconscious. Gold is rising because gold is more honest. Gold is rising because at the subconscious level it knows this is not sustainable. And I think when you're looking at this market right now, and again, I won't say it's going to end on date X, 2025, 2026. That's ridiculous. I can tell you some things I'm looking at, but people forget that there have been 22 bear markets since 1925 in the U.S. And I'm talking about U.S. markets because they're so important. And half of that time, the markets are recovering from the pain of when those bear markets really hit bottoms. And the next half is making money when they recover. But in 1929, when we had the bubble crash, it didn't recover until 1958. In the 72 oil crisis, stocks didn't recover their old highs until the mid-90s. And the tech bubble that I was the beneficiary of when it crashed in 2000 didn't recover in 2011. And in the case of the Nikkei, it took 89 years. It took 30 years from 1989 to get back to its highs in inflation-adjusted terms. So the idea is, just because we're in a ripping market, and especially if you're an older investor, not if, but when these markets mean revert, unless they're nationalized by the central banks and currencies just go to zero, when these markets mean revert, many of you won't have 30 years or 12 years or 15 years to wait out that mean reversion back up, and you won't have the timing right at all. But there are many who will say that valuations and earnings don't matter because AI is different now. AI is this new and brilliant, shiny thing. We're not in a bubble because AI is different. I heard that during the dot-com bubble. I heard that. The Internet of Things, the dot-com of things. But if you look at railroads or automobiles or the Internet, there's always too many tracks laid or too many dot-coms made. Everyone does it. There's an overinvestment. People forget that Amazon lost 92% when other pet.coms and toys.com were dying. Amazon lost 92% of overinvestment, too many players. And so then you look at NVIDIA today at $4 trillion in market cap in such a short time. And the argument is AI is new and shiny. It is too brilliant. This is not a bubble. This time it is different. What's very creepy about AI, I'm not saying it's not important. It's certainly, the internet was important. Railroads were important. Automobiles were important. Electricity was important. AI is important. But the greatest believers are the richest companies right now who really can't buy enough from NVIDIA. NVIDIA is like Grantham said, it's like selling shovels during a gold peak. They're just raking in the money right now. And the major companies, the 7 that are holding up the S&P, are spending $60 billion or more a year on AI. So NVIDIA is capturing all this. It's sucking all the 7 into it. The fabulous 7, the magnificent 7, are all top-heavy in AI, in NVIDIA chips. And I'm not saying it's inevitable, but what if NVIDIA had an Amazon moment where it lost 90%? Then the magnificent 7 lose 40 or 50%. The magnificent 7 are the market. So that's a very dangerous market. People always ask me, because I was a veteran of the dot-com bubble. I benefited from that bubble. There's a lot of similarity to the current market today and the dot-com bubble. What's more dangerous is it's more concentrated and fewer names, and the risks are higher. And you'll say, well, when will AI become obsolete? Never. It'll just be overbought. And the signs I would look for are just the net income margins on these companies. As long as the net income margins are rising at a trend, the bubble continues. When those net income margins start to flatten and then trend below trend, that's when you don't short the market. That's when you get out of the market. But there are so many needles pointed at this bubble right now, whether it's recession, whether it's higher rates, whether it's a war, whether it's a potential assassination. This is not a time for me to be chasing tops. And like Jeremy Grantham was in 2000, when I was just an idiot going long IPOs, he was more in cash. And so investors can be more in cash. They can be in cash hedges like precious metals. They can be in cheaper equities like there are in foreign jurisdictions and not the U.S. that'll bounce back faster. Or they can be in cheaper assets or hard assets. But to just be faithful in this market, which by every metric is the most overvalued market in history. If you think this time is different, I would beg to differ, even if I miss some of these highs. But what? The S&P gave us 7% this year. To me, that's not worth the upside. The risk, the downside risk is so much higher. But there is this notion that the markets will save us, that the US dollar will save us, that Trump will save us, that the world reserve currency will save us. None of those things. I'm not talking about Trump versus someone else. A politician, a monetary policy, a currency, or a market, whatever your jurisdiction, cannot save us from these debt levels and from the debasement to come, which is already in play for years, and for the risk facing these markets. I just wish that more investors would consider that. It doesn't mean go in a corner, hug your knees, and give up, but consider the risks, and don't trust everything your politician, whatever your favorite politician, left or right, says, because no politician, left or right, has a magical wand that can solve a global debt crisis of this magnitude, like anything we've ever seen before. And as David Hume said, debt destroys nations, it destroys peace, it destroys liberties. What are we seeing right now? All of those things are being destroyed. Free market price discovery has been destroyed. And so, yeah, going back to your very first question, we live in very, very interesting times, volatile times.
Very interesting times indeed, and we'll talk about precious metals in just a second. Really appreciate you going through all these questions, Matthew. But touching base on equities for a second, for someone perhaps a bit younger who's trying to build wealth still by compounding over the long term, is this a value investors market? Are there still opportunities to be found?
My daughter and son are in their late 20s, and they work in markets and banks and investing, and of course I have a strong influence on them, and they they have to find their own way. When you're a young investor, yes, there's so much sexy trend following right now. I certainly was a trend follower in the dot-com bubble, and I was able to get through contacts into some pre-IPOs. I didn't believe in them, but I saw the fat pitch. I swung because there was no doubt that momentum and consensus think is a trend, and if there is a momentum in your favor, you should follow it, especially if you're early in that market, like I was during the dot-com craze. I was early, and I was young, and I was greedy, and I had it like every young person. You want to get a chance to make some money in these markets if you're leaning that way. But I think these markets are so overbought now that if you're coming in now, I tell my children who are in their 20s, the most important asset right now is patience and in contrarian thinking, not just to be contrarian to be hip, but contrarian because you're informed. Why would you want to chase 7 basis points a year, or maybe more, in NVIDIA a hell of a lot more, when the downside is so high? You can pick certain stocks like NVIDIA, and God knows anyone who picked NVIDIA or even Bitcoin, some have made massive fortunes. I do not mock that. I would have probably done the same. If I would have done it carefully, but I would have done the same if I were young. I think now at this turning point, the risks are still too high. I would wait for Bob Farrell's mean reversion. I would do what old gray-haired fogies like Warren Buffett are doing, going mostly to cash so that they can buy when, as Baron Rothschild said, when there's blood in the streets, when the markets are tanking. And this is what Jeremy Grantham's third investment advice was: buy when you're terrified, not when you're cocky. Wait for these markets to be so scary that no one wants to get back in. And for the younger investors, I understand the temptation to follow XRP or follow Bitcoin, and there's many good reasons to do it, and they probably won't listen to me, or maybe NVIDIA, or even follow the Mag 7. I really understand that. I think the safer play, the smarter play, the more patient play is buy Amazon, quote unquote, when it's down 92%. Buy NVIDIA when it's down, mean reverted down 50 or 60%. These net income margins are not sustainable. They may rip for 5 more years, but they will mean revert. I think NVIDIA, like Lucent, like Qualcomm, like a lot of companies I invested in the 90s, like Microsoft, are still excellent companies. I would just want to buy them when they're fair valued. And I would wait for that blood in the streets. I would be very patient. That's almost impossible to do when you're 28. You're trying to make some money. You're trying to beat inflation. You're trying, since the job market is so pathetic, since the chances of buying a house are so much harder, since inflation is so bad, that you're trying to make it in the markets like you would at a casino. I totally understand that. Sometimes the best thing to do, the best asset, is patience. Wait for that mean reversion. And people say, well, maybe it'll never happen again. No one could have thought Amazon was going to lose 90%, but it did, and it bounced back. And no one thought Lucent or Microsoft could lose like they did, but they do. And I think the same will be true of the Magnificent Seven now. I would just buy them when they're cheaper and not when they're expensive. I joke, I don't buy a Snickers bar for $20. I could, you could, we all could, but who wants to pay $20 for a Snickers bar? I don't want to pay $50 for a Snickers bar and a NVIDIA label. I'll just wait. And again, Pollyannish advice from a guy in his 50s, when you're in your 20s and 30s, to your question, you want to capture something. Even if you're capturing the upside in the volatility of altcoins, or you're capturing the upside in tech, that's excellent, that's fine. But have your stop losses, your exit points figured out before you enter the trade, so you don't get seduced and think, I just want a little bit more, I want a little bit more. I've seen many family offices and many investors lose their fortunes because they wanted a little bit more. I'm just an old-fashioned guy now who wants to buy at bottoms and not tops. And I think that's what Buffett's doing. I think that's what Graham is doing. I think that's Gunleck's doing. I think it's what Druckenmiller's doing. So I'm not alone in this. I think I'm all in favor of speculation when the targets are right, when the opportunities are right. I know people that are totally concentrated in Bitcoin. I won't even get into a Bitcoin debate. That's fine to be positive on Bitcoin or to have made money in Bitcoin. I know more that have lost. But I know some who have their entire retirement, their entire financial future trapped into this one asset. And I'll say I have learned from the markets that the three biggest risks other than leverage and timing is concentration. If you're concentrated that heavily in one asset, you're going to either be a goat or a hero, but most of you end up as goats because that's extremely dangerous thinking. But I understand the temptation to hear what you want to hear, to be in a positive feedback loop about certain assets, certain sectors, or certain stocks, and say, I can't be wrong. This is going to change my life. Someone said, well, Bitcoin can go to 0 or 1,000,000. It's not going to go to 0, so that means it's going to go to 1,000,000. That's not rational thinking. It could go to 1,000,000. It could not. But to have your entire wealth in that, I think, is extremely dangerous. So I see too much of that going further and further out on the risk branch, looking for some return. And that is great when the markets are trending bullish. That is an absolute nightmare when there's a mean reversion and a correction. And as I said, you can identify and you can measure these obvious bubbles. You cannot time them. So you're playing Russian roulette with your portfolio. And again, at the very least, please look at the yield on the 10-year. When that goes above 5, please be careful. And look at the net income margins of the stocks you own. When they start to trend negative, you may want to think about cashing out. That assumes we don't have some overnight disaster. But it's a very dangerous and seductive time to be a bull. I get it. It's easy to give advice when you're 55 and you're in gold and you're out of the markets. It's smug. I get it. But I'm saying that because I'm very concerned about people being led towards a cliff here. And, I've been concerned for years about this, but I've also been bullish when I could. 2020, when the Fed's doing unlimited QE, I'll take that. 2024, Powell's announcing rate cuts, I'll take the short-term trade. But I'll always trade with an idea to my exit before I enter. And I think a lot of people right now are just buying and holding and hoping for the best. And thinking the Titanic won't sink even though the water levels are rising higher and higher. I think that's very dangerous.
Couldn't agree more. Very dangerous times. And of course, if you're willing to put in the work, perhaps there's opportunities to be found in overlooked markets, perhaps oil and gas industries like that, where you can find value. But general market, definitely, I'm personally staying away.
Yeah.
Talking about gold for a second, I know you're, of course, a gold bull with von Greyerz, which we'll talk about in a second as well. Perhaps we can outline really what the opportunity at hand here is. Is it just preserving of wealth, or is there also an opportunity? Is there a trade here where there might be a shift towards gold that you can benefit from?
Well, look, I came from Wall Street. I worked in banks. I had hedge fund experience in New York. I was a family officer in New York. I talked to hundreds of hedge funds for the last 25 years, and everyone said gold's too volatile. Gold's too volatile. And, there's a vested interest in not talking about gold. The fact is gold's outperformed the markets. You could have started a hedge fund in 2005 and just gone long gold, taken 2 and 20 on the upside and done very well. So that the argument that gold is too volatile, which was consensus think and personal self-interest think, is just specious now. It's just proven wrong. So yeah, and in terms of pure price optionality, gold has been a fairly safe and superior investment. Now, you can pick your statistical window and show when gold wasn't, so I get that. But for 2 decades, gold has outperformed the biggest bull market in the S&P. I think that is something worth considering. And absolutely, when Egon von Greyerz, my colleague, bought gold at 300 decades ago, he wasn't looking at price optionality or I'm going to buy it at 300 and sell it 3,000. He just says, I don't trust the fiat money. I need to insure paper money. I need to understand the history of money. I need to look at the derivative market. I need to look at what the Fed and the central banks around the world are doing. I have to look at the broad money supply, how that debases currency. So he was looking at gold purely as, if I got to save in an asset, I'm going to save in something that holds its value. And so gold to him was obvious, and he was highly concentrated in gold. Of course, he bought it at 300. He bought a significant amount. He was a very successful guy, led a FTSE 100 company, made a great deal of money, and saved that money outside the banking system in physical gold because he was saving, he was preserving, he was insuring against fiat money debasement. That was an absolutely brilliant idea in terms of pure sound money, saving in gold and spending in fiat. Now, the fact that in that same period of time, gold's gone from 300 to over 3,400, of course he's happy to see the price optionality. Of course it was the right investment in terms of total and absolute return, but that was never his first thought. But to answer your question, going forward, I don't think gold's first chapter has even begun at 3,400 or 2,600 or 2,200 or 2,100. So in terms of just pure speculation, yes, gold will go higher, never in a straight line, obviously, But if that's your only play and you're looking to trade gold 3 to 6 months or 3 to 6 days, that's a very different question. And it's a very different answer. I don't know many people who've traded precious metals in the short term well. If you're holding it for the long term for the fundamental reason that it's far more valuable than whatever currency you measure your wealth in, when the world understands that, no matter what the gold price is, it holds its value more than paper money. If that's the first step, fantastic. And your investment window should be years ahead, not quarters ahead or financial cycles ahead. By the way, while you're preserving the purchasing power of your money, your real money, which is gold, the rest is credit, you also have the upside potential of seeing that double or triple in price. When gold's at 4,800, which it will be, I won't be happy, because that means the cost of a loaf of bread will be a lot higher, or the cost to rent a car, or pay tuition, or pay a medical bill will be grotesquely higher, whether we have a deflationary intervening period. So it's not like you're gloating when gold's at 5,000, 6,000, 10,000 or higher. That just means the purchasing power of the currency you hold is getting crushed and the world around you is struggling. So it's not a gloat. But yes, you can invest in gold, whatever your age, and hold it for the long term and get not only the preservation benefit of protecting you from fiat money that's burning. It's literally like buying CDOs during the during the real estate crisis when mortgage-backed securities were dying. They were handing out insurance on that for free. You could still protect your paper wealth by buying physical gold, insure against its debasement. But you'll probably also see massive appreciation in the price of that spot price of that metal. But again, it's young people, and I understand it. They're chasing sexier tech names. They're chasing sexier trends, and they can do very well. I have talked to young men in their 20s and late 20s and early 30s who've come all the way to Switzerland, who couldn't meet our minimums at Von Greyerz, who follow our thinking and have been stacking gold and silver now for 5 or 10 years. Are they making as much as they could have in Bitcoin, or lost as much in Bitcoin or in Nvidia? No. Am I proud that they're doing that? Absolutely. They're not going to be my clients. I'm very proud to see a young generation thinking 20, 30 years out. And I'm very proud that my kids are stacking gold. And I said, you buy it in your 20s so you can spend it in your 70s if you need to. But, again, it's a long-winded answer. Again, I'm not mocking speculation. I'm not mocking the desire for a 10-bagger in the equities market or in tech. I did that. I got lucky. And that was all it was. But as you get burned by subsequent bubbles, or you learn the lessons of history and life, you start to think more about better safe than sorry. That's just my mentality. I would not mock, though, those that are looking for that fat pitch home run. They're just very hard to find in these markets. But I see gold as a preservation asset, to your point, but also price optionality is embedded into this market, because gold is not just a hedge against inflation or insurance against fiat money. If you look at the direction of gold, the central bank purchasing of gold, the outflows out of COMEX, the BIS classification of a tier 1 asset, the net settling of most global trades in the BRICS in gold, not a gold-backed BRICS currency, but net settling in gold, purchasing and arbitraging oil in gold. Just look at the facts. Gold's not just a hedge or a precious metal or a monetary metal. It is becoming a cornerstone of the next 20, 30, 40 years. And whatever reset or chaos or smooth solution comes, the IMF to the BIS to JP Morgan recognize that gold is going to become central. And it doesn't have to be a gold-backed dollar or a gold-backed yuan or a gold-backed ruble. It could be, but more importantly, gold will become far more important once it's revalued as a way to net settle trades, as a way to purchase energy outside of the petrodollar, as a way to avoid a large monopoly of the control in the SWIFT system or the U.S. dollar reserve system. It's coming. It's already happening. It's happening right in front of us. Again, you can see the soldiers lining up on both sides of the border. You can see that gold is not just an appreciating asset or an alternative to hedge against inflation. It is becoming a cornerstone of the new financial system, which is merging from the BRICS and even in the West now. And there's even talk about gold revaluation. I've written about it. These are not fantasy thoughts. They are the necessity. There has to be an asset. Even Scott Bessent said we need to remonetize certain assets. At 37 trillion in public debt, they'll probably revalue gold at some point. It'll happen overnight, like 1971 when we went off the gold standard. You can't predict it. You can't time the mentality or the secrecy or the mechanizations of a politician. But if I were a politician, at some point, you can do QE through gold. You can literally revalue gold and then suddenly take down your debt to GDP from 120 to 90 to 80%. The problem is if the U.S. revalues gold to 20 or 15 or 10,000, the rest of the world does too. And countries like Russia and China have more gold than the U.S., in my opinion. I don't look at the World Gold Council. I look at the data. And so be careful what you ask for. That will help the U.S. get out of its debt to GDP crisis. But other countries that have been stacking gold far longer than the U.S. will have more leverage than the U.S. when it comes to their gold protection, their gold ownership. So it's very interesting times. I mean, I joke, but Polish housewives have more gold than the UK because Gordon Brown sold all that gold at 270 an ounce because he was a short-sighted thinker. He didn't think longer term. England's in a mess. Europe's in a mess. So a long way of saying gold is far more than just a preservation asset. It's also going to be a cornerstone of the new system. It already is a cornerstone of the new system. So I'm not even predicting. I'm not even forecasting. I'm talking about what's happening in real time. And yes, it will also rise in price, but of course, never in a straight line. If you're looking to trade for the next 30 days, I can't give you any advice. If you're looking to hold for a long period, I absolutely believe in it.
100%. And touching base on Von Greyerz, of course, perhaps you can outline really what you guys are doing over there.
Yeah, well, we're pretty boring too, in a sense. I joke, and Egon hates it. I say we're insurance salesmen and landlords. I mean, we're insuring against the death of paper money, the slow but obvious death of paper money. When measured against gold, paper money's lost over 98% since 1971. So we are just ensuring that through physical gold, not tokenized gold, not ETF gold, not bank-held gold, but physical gold outside the banking system, and where we store it in the safest vaults in the world in Switzerland and Singapore. That's being a landlord. We charge a fee for the storage, and we charge a fee for the service of getting that gold from the Swiss refineries where the best gold in the world is. And then, of course, we provide liquidity when needed through our own in-house trading desk with the refiners and the banks. So when you want to save in physical gold or silver, you can spend in dollars or euros or Australian or Canadian dollars when you need it, but it's better to save. So our business model is based on physical gold and silver outside of the banking system, held, allocated, and segregated in your name, outside of a banking system which is highly levered and highly operational and risky, no counterparty risk. And then we provide full insurance, full transportation, and full transparency on that. And then when you need liquidity and fiat money, we provide it. But it is the idea that we are trying for decades, and our warnings have only been confirmed by history, that you have massive banking risk, you have massive currency risk, you have massive political risk, and you have massive market risk. And so gold is one avenue towards addressing those risks, not the only. It certainly can't protect us from a mushroom cloud over Kiev. I don't know what's going to happen tomorrow. No one does. But on a relative basis, the jurisdictions we've chosen and the asset we've chosen is the best option available in those areas. And, that's what we do. And we do have higher minimums, so it's not for everyone. Our minimums are very high. We're the largest gold service provider for ultra high net worth investors around the world outside of the banking system. But everything we write and every interview I make and Egon makes, it doesn't have to be just for our clients. It's for anyone who's trying to understand gold. Our website has a whole free educational series of articles and interviews and a whole section on why gold. You don't have to be a Goldbug to take a dive into that, look into that, educate yourself. You don't have to become a client to understand that. My job at this point, of course, is to service our clients, but I want to educate or at least give my opinion on the financial, credit, debt, currency risk that are real, and offer gold as one option. Whether you can only afford a couple grams or an ounce, it's not too late to consider it. And you should be cynical about anyone who's selling a product they have high conviction in. But I'm not at a point now, nor is Egon. We're both from Wall Street. We're both from a banking background. We don't need you to buy our gold. We want you to be educated on this, and that's the least we can do in trying to teach this to more people.
Yeah, really appreciate that. And it seems that from a historical perspective, there are worse things than to become a gold bug.
And probably better things too, I suppose. But I'm very comfortable with it. It's the kind of asset that, of course, I sleep better at night on. I certainly would have made more money levering 3x position in NVIDIA 4 years ago, of course. I'm not here to mock anything else. I'm not even here to mock alternative altcoins and Bitcoin. I just see them as speculation assets, not stores of value. And that upsets a lot of people in the crypto space. It shouldn't. You can still do very well if you know how to trade it and you have your conviction. And there's a lot of political reasons why Bitcoin will do well. It's paired to the dollar. It's a loss leader to get more interest in U.S. Treasuries and U.S. dollars under these new acts. So it's almost too big to fail, but its volatility and its profile and its origins are still too species for me. And I'd just rather have gold. That's just me. But, everyone has to make the decision on their own.
Thank you so much for your time today, Matthew. Really appreciate it.
My pleasure. Thanks for inviting me.